Hi, my name is Matthew. Welcome back to part 4 of our 5-part property series. Today we're going to be talking about property inheritance. There are 2 reasons that you might end up inheriting a property or part of a property. 1, you inherit it when the owner dies and the property has been left to you in their will. Or 2, you already own a share in the property as a joint tenant and your co-owner dies. Let's look at the difference between these 2 scenarios. While it can be upsetting and overwhelming to inherit a property from a loved one when they pass away, it's important to know what this means for you and how to manage it. If someone has left their home to you in their will, but you're not named as an executor, you don't have any legal responsibilities, but you should make yourself familiar with the deceased's will and communicate with the executor throughout. Now, let's go through the legal and financial steps that need to be taken before you can inherit the property. If the person left a will and you are named as an executor, you're responsible for carrying out their wishes and overseeing the distribution of their estate. When someone dies, the executor of their estate will need to apply for a grant of probate. This is a legal document that's required in order to access the deceased's bank accounts, settle their debts, and sell their assets such as their home or car. If there isn't a will and you can't determine who is entitled to the deceased's estate, this means that the person has died intestate. In this case, you'll need to know what the rules of intestacy are. You can find out more at gov.uk. If you're entitled to inherit under the rules of intestacy, you'll need to apply for letters of administration. Both probate and administration work in more or less the same way by giving the executor the authority to deal with the person's estate. After applying for probate, the executor will need to work out the value of the deceased's assets and liabilities. Assets could include property and savings. Liabilities might be outstanding debts. This is also when the executor would look at who's entitled to inherit what based on the person's will or letters of administration. Inheritance tax, or IHT, is a tax paid on the deceased's estate, including all of their property, possessions, and money. The standard rate is 40%, but it's only charged on the part of the estate that's above the tax-free threshold. The inheritance tax-free threshold does get revised by the government. You can find the current threshold in the description box of this video. During probate, the executor will need to submit an inheritance tax return. This must be paid within 6 months of the person's death. If not, HMRC will start charging interest. Once these legal steps are handled, the executor will be able to distribute the remaining assets and settle any further inheritance tax. There are a further 2 types of tax that may also be incurred here: income tax and capital gains tax, or CGT. You have to pay income tax if you inherit something that produces a regular income, like rent from a property. You must work out and pay income tax on the full amount of income the estate receives between the day after the death and the date everything has been distributed. You have to pay capital gains tax if you sell the property for more than what it was worth when the deceased passed away. You don't pay capital gains tax from the estate if you transfer assets directly to a beneficiary, for example property, rather than selling the asset and giving the cash proceeds to the beneficiary. Typically, the power to sell the inherited property lies with the executor. However, this is somewhat dependent on how many beneficiaries there are. A beneficiary is someone who is legally designated to receive some of your money or assets in the event of your death. If you're the sole beneficiary, you should have a significant say in decisions relating to the property, including the decision to sell it. But if you inherited a property jointly with, say, 3 siblings, the executor may believe that selling the property is the most equitable way to distribute the deceased's assets. Once ownership of the property is transferred to you, you'll need to put the mortgage in your name, if the property has one, or set up a new mortgage arrangement. Bear in mind that you'll still have to pass the usual affordability and credit checks. If you own the property outright with no mortgage, then you can move in straight away. There's also the option of renting the property out if you want to keep it, but don't want to live in it. As mentioned earlier, the second way you may find yourself inheriting a property is if you're a joint tenant and your co-owner dies. In this instance, ownership of the property will automatically transfer to you without having to go through probate or court. This is known as a right of survivorship. As always, professional advice needs to be tailored to any given facts. The information given in this video should not be regarded as legal advice. You should seek legal advice from a solicitor to assist you with specific questions. Thanks for watching, and don't forget to watch the other episodes in the series.